and welcome to my Venture Capital Outlook for 2024. In the course of this presentation, I'll be talking a bit about me. I'll be having a look at some of the things that I said in 2023 and saying where I was right and where I was wrong. And then I'll be going into my outlook for venture capital in 2024, giving some advice and recommendations, explaining why I'm bullish on African tech, and then bringing you into the conclusion. So 2023 was a really interesting year for VC. Lots of stringent monetary policy coming from central banks around the world, a VC funding winter, and slower deals. But I think 2024 will be a great year for venture, marking, a real resurgence in purpose-driven partnerships and lasting success stories. But before I go on, I'm going to say a bit about myself. My name is Dr. Ola Brown. I'm a venture capitalist. I work in Africa. We invest in two sectors, health tech and fintech. We already have over 18 companies in our portfolio in health tech and fintech, and they have their collective value is about $700 million. They've created 1,000 job opportunities on the continent, and they have operations in 10 countries. In terms of my academic background, I started off as a medical physician, would you believe? So bachelor's in medicine and surgery, master's in finance and economic policy, and I'm currently completing my PhD in finance at the University of London, focused on fintech and monetary policy. I produced or co-written 2 reports, Impact Investing and Healthcare Financing in Africa, and the Health Tech Unicorns report. They're both free to download. In terms of communities, I'm a member of Women in Finance, where I lead the Gender Equity Committee. I'm a member of IPO. I've spoken at the Qatar Economic Forum, spoken at the Lagos Business School. Up until the end of this year, I was also head of healthcare as a business for the NESG, and I've spoken at the Kaufman Fellows Summit, which is a VC fellowship. I'm not a Kaufman Fellow myself, but I have spoken at the event. In terms of if you'd like to learn more about VC, I also have a free YouTube channel where you can learn more about venture capital, economics, and finance. In terms of my track record in VC, my first fund that I ran, I gave 5 times money back to investors, which placed it in the top quartile of funds worldwide. So that's my introduction, going on to setting the context. So what did I predict in 2023? If you want to see my 2023 predictions video, then I'm going to link it in the comments below. But what did I say in 2023? I had 6 main predictions. Number 1, that there was going to be cost cutting in startups. So startups would have to cut costs to survive or shut down. That definitely happened. I also said that there'll be stricter due diligence and longer due diligence processes for startup investment. And I think all founders watching can testify that that definitely happened. I also said that some later stage funds would move into early stage funding. And that definitely also happened. I said that there'll be a few survival M&As. So not buyouts, but actually startups just merging to be able to survive. And that also happened as well. I also predicted that there'd be more of a focus on revenue and profit over growth. And I think, over the past year, everybody can testify that kind of happened. And I said valuations would fall. So what did happen? If you look at all of these indicators in terms of IPO exit values, in terms of the decline of venture capital deals, and the decline in deal value, it looks pretty brutal. So in my 2023 video, I predicted most of these things, and most of these things came true. So let's see if I can do the same in 2024. Another thing that I just wanted to move on to before I go into the 2024 predictions is Silicon Valley Bank. It was quite a significant event. That bank almost failed. It was registered. It was rescued by the American government that secured all the deposits. And really, I think that it sent a real shockwave through the ecosystem and gave a really practical demonstration of the influence of monetary policy and rate hikes on the financial system in general. So, 2024. I'm going to be placing my insights into 5 main buckets. I'm going to be talking about monetary policy. I'm going to be talking about some other macro issues. Of course, I'm going to be talking about valuations. I'm going to be talking about the geopolitical shifts that we're seeing. And I'm going to be talking about why I'm so bullish on African tech. Monetary policy. It was a big topic last year, and it's going to be a big topic this year. Now, over the past 150 years, we have seen interest rates in developed countries hardly ever touch zero. So I'm going to go and show you. If you look here, for instance, this was back in 1870, right, to 1920. Interest rates have always kind of hovered above that zero mark. They dipped down slightly between 1920 and 1970, but then they go right back up. The only time in 150 years that interest rates in developed nations have actually touched that zero mark was in the years leading up to 2020. Zero interest rates, even in the context of the past 150 years, are an outlier sort of phenomenon. They're abnormal. So what we saw in 2020, where you saw massive amounts of capital moving into startups that were barely viable or not viable. You saw a lot of, quite reckless, I would say, due diligence processes, a lot of FOMO. That was a highly abnormal market. And it's a kind of market that we've not seen in the past 150 years. So heading into 2024, I think I can safely predict that interest rates are probably going to stay higher for longer. Now, when you look at what the Federal Reserve in America has been saying, they've been saying that it may be the end of the rate hiking cycle. And a lot of people I've seen are taking that to mean that rates are going to go back down to zero and the fun times will keep on rolling. And that's not exactly what the Federal Reserve is communicating. What they're communicating is that it may be the end of the hiking cycle, but even if there are cuts that are going to come, we're not going back to zero. And I think I can say that with some relative sort of certainty. So my prediction on monetary policy is that the rates are going to stay higher for longer, and not just because of the historical patterns, also because of what's happening in the world. So we have two wars going on right now, the Russia-Ukraine war and the Israel-Hamas conflict as well. And the interesting thing about the Ukraine-Russia war is even when you have absolutely no connection to those countries, sometimes it can touch you in unexpected ways. And I'll give you an example. Before I started working in venture capital, I used to run an air ambulance company, medical transportation, emergency assistance across Africa, operations in 40 countries across Africa, and one of the largest emergency firms actually in West Africa. And we had an aircraft going for maintenance from one of the people that we leased from. And one of the leasers, I was having dinner with one of the partners, and he said that there was a tiny part of the engine that during servicing had a fault. And that tiny component of a component that made up the larger part of the engine was manufactured in Ukraine, and the factory had stopped manufacturing it. Now, he was going to have to get this part from China at 10 times the cost, and it was going to take 5 times longer. So these global conflicts sometimes we think have absolutely nothing to do with us until we start thinking about the complexity of the global supply chains. And actually, one of the arguments for globalization when we first started sort of bringing the world together and trading as a global village was that it would stop most of the wars because it made us so reliant on each other. So one of the arguments for globalization was that, people will go to war less frequently because they were so reliant on each other. And unfortunately, these supply chain disruptions that these conflicts produce raise costs. And when costs rise, of course, that's inflation. So they produce some sort of inflation. Now, in all my readings, I haven't really come across examples of the US government election causing huge rates of inflation, even though spending does increase during this time. But we do have a high baseline level of inflation in the US right now. So the extra cost of transportation, the extra, billions of dollars spent on marketing and on advertising may actually exacerbate the level of inflation in the US, keeping rates high. Now, what does that really have to do with venture capital? When rates are high, that means that the risk-free return that investors can make on government treasuries, risk-free in quotes, is high. It means an LP, a pension fund, an endowment fund, a high net worth individual, a family office, can put their money with the US government and get a risk-free 5% return for doing absolutely nothing. That's a lot easier than locking up their money for 10 years with a venture capital firm. So when interest rates are high, like they are now, less money goes into venture capital firms, then that means that less money goes into startups. So my prediction is that interest rates are going to stay higher for longer, based on historical evidence, as well as evidence that we're seeing from the global conflicts, as well as rising energy prices, which should produce inflation, which we fight by raising rates and keeping rates high. That means that more investors that would typically invest in venture capital and private equity will move their investments over to risk-free assets, or things like private credit now become more attractive. And that means that persistently high rates will restrict capital allocation to the venture capital asset class, leading to reduced funding from LPs and decreased funding for startups. So that's really my perspective on monetary policy. I'm going to talk about the macro situation a bit more because I think it's important. During the pandemic, Americans had a lot of disposable income. So a lot of money went into sort of, soft subsidies. They call it helicopter money in economics. They call them the COVID checks. So Americans had a lot of disposable income. And that buffer, according to the research that I've looked at recently, has completely gone. So now Americans have constrained disposable income. There's a rise in cost of living. And also the rate hikes actually happened quite rapidly. This is what Silicon Valley got caught up in, the duration risk. So the rate hikes happened quite rapidly over time, but even corporates as well as individuals have started running out of those financial buffers. They're going to have to go back to their banks and refinance their mortgages for households and their corporate loans at much higher interest rates. It's a real test of your business model when you go from lending from 1 or 2% interest to 5% interest. Now, if in a scenario that the companies and households are very resilient and the economy continues to grow, then there's more chance of interest rates staying high. However, if companies start failing, if households start going into real difficulty, and America falls into a recession, then the Federal Reserve, particularly in an election year, will be forced to cut rates. Because nobody wants a recession in an election year. So if there's no recession, then I predict interest rates will remain higher for longer. The only scenario where I think that we'll go back towards zero interest rates is if there's a recession in America. And I've described some of the factors that could lead to a recession in America. A recession in America would be, terrible for any of the candidates going into sort of from the leading party right now, going into the election. So the Federal Reserve will probably cut rates to improve economic growth. And that's when we might see a scenario of cut rates. But from the numbers that I've looked at, I would predict that there's only probably a 20% chance of going into a recession. So there's some other macroeconomic themes that I want to explore. I've spoken about the rising energy prices. Right now, there's war in the Middle East and there's war in Russia. Two energy powerhouses are sort of being disrupted by conflict. So that's in addition to the fact that we're trying to transition into new, cleaner forms of energy, will mean higher energy costs, which affects inflation, which goes with my thesis of interest rates being higher for longer. We have the US election year, which I've spoken about. Massive spending, some of the most expensive elections in the world are coming up. Lots of spending on advertising, lots of spending on marketing, lots of spending by government. So, that also has some kind of inflationary effect. From the numbers that I've looked at, it doesn't look like a strong inflationary effect, but on top of existing inflation, it might be something to think about. Now, the Chinese property market, you might think, what does the Chinese property market have to do with African VC, right? But actually, the Chinese property market is going through a crisis right now. And the Chinese property market is 30% of the total Chinese economy. So it's bigger than agriculture in Nigeria. 30% of the Chinese economy is the property market. So when the property market in China has a problem, China has a problem. So how does that really affect Africa? Apart from Europe and America, Chinese investors are big in Africa. They bring in money to Africa. They build airports, they build roads, they build bridges, and there's almost no country in Africa that hasn't benefited from, I use benefit in the relative sense. People do have different opinions about whether Chinese investment benefits Africa, but has not received investment from China in some way, shape, or form. They might be less likely to do that when their economy is in crisis. And that affects African GDP. The last thing I'm going to say is about the stock market, particularly the American stock market. This is unpublished research because one of my PhD professors has just finished this research, and when he gets it published, I will also link it below. So if you're watching this later on in 2024, I'll probably have a link for you to have a look at that research. But he has been looking at geopolitical risk and IPOs. And what he has found is that when there's high levels of geopolitical risk, the number of IPOs drops, but the quality increases. So my prediction, in line with his research, is that the number of IPOs will continue to remain muted, but the IPOs or the companies that do come to the market will be very high quality. Now, the reasoning, or his hypothesis around the reasoning, is during boom periods when everybody's spending money and there's zero interest rates and everybody wants to start a company, then you find actually that investment bankers and brokers are inundated with IPOs. So they do less due diligence and poorer quality companies come to the market. However, when there are fewer IPOs and less work for the investment bankers taking companies to market to do, then you find much better quality companies because they do more due diligence. Now, I'm going to go to my outlook for tech, but before I go into that, I'm going to give one of my sort of favorite quotes of any financial experts. And it's by Howard Marks, and his book is called Mastering the Market Cycle. If you haven't read it, I would strongly advise you buying the book. He's, an excellent thinker about finance, and I think that he has some really interesting insights. And this is one of his quotes. He says, "Superior investing doesn't come from buying high-quality assets, but from buying when the deal is good. The price is low, and the potential return is substantial, but the risk is limited." These conditions are much more the case when credit cycles are more in the euphoric and more stringent part of their cycle. The slam shut part of the credit cycle probably does more to make bargains available than any other single factor. And I'm going to say that again. The slam shut phase of the credit cycle probably does more to make bargains available than any other single factor. And guess what part of the credit cycle we are in now? The slammed shut part of the cycle. So this is the time to go bargain hunting, particularly when it comes to technology companies. So the outlook for tech in 2024. The current scenario is less funding going into startups, and that means that with high interest rates and the influx of capital into VC funds diminishing, startups are going to have to reduce their valuations. And they reduce their valuations to get investors interested and to help them navigate the complex terrain when you're investing through a downturn. And this presents a strategic opportunity for investors to enter the market with the potential for increased value once we go back into the upcycle. So entering the market at reduced valuations offers a strategic advantage for investors, considering that companies are obviously poised to achieve a much higher valuation once we go up into a more sort of buoyant market. And I'm going to quote Jamie Dimon, I don't quite know how he pronounces his name, famous managing director of JP Morgan. And this is one of my favorite quotes from him. He says, not to be funny about it, but my daughter asked me when she came home from school, what's a financial crisis, Daddy? And I said, well, it's something that happens every 5 to 7 years. And I think that this is a super interesting quote, because in my 2023 venture capital outlook, I spoke about the Bible story where Joseph was prime minister of Egypt, and God revealed to him that there was going to be a 7-year economic boom and then a 7-year recession. So right from probably, I would say, 15,000 years before Christ, when Joseph was running the economy of Egypt, to 2023, when Jamie Dimon is running the economy. I think that 7-year kind of boom and bust cycle has been consistent. So the strategy really is to invest during recessions and capitalize on the upswing. Now, I said in the earlier slides that I'm not sure if there's going to be a recession, and I probably put the sort of risk of a recession at about 20%. But I really, really think that Gen Z and the millennials actually need a good recession, because the boomers acquired their Apple shares and their Microsoft shares and their houses with the money that they had saved up during recessions. And I came across a statistic that there are more people in the UK and the US living with their parents in their late 20s and 30s than in recent history. And I think part of the reason for this is that the Gen Zs just haven't had a real recession. And they haven't had a chance to be able to spend their savings to buy up equities and to buy houses. They're not getting on the housing ladder because the prices have remained high. So I guess the bad thing about being born into a time when the economy has been, good for most of your life is that you're reaching adulthood without being able to have the benefit of a time when assets are really cheap. So recessions are bad for all kinds of reasons, but I think for Gen Z, if they don't want to be living in their father's house at 40, then they probably do need a recession so that they can buy up some of those cheap assets, so they can move out of their parents' houses into their own houses, and so that they can actually get hold of some cheap equities. And yeah, I said it's about 20%. And it happens sort of once every 5 to 7 years. So we are kind of due for a recession. And if it happens, then, it's not necessarily, a disaster, because that's the way market cycles work. But looking at the economy, I'm not sure that America will go into recession. And even if it does, or it approaches, and I think the Fed will bring in really, really rapid rate cuts to curtail that and to get people spending again, and obviously to get people investing again. One thing that I haven't spoken about is the geopolitical shifts that we're seeing. So geopolitically, we're seeing the rise of what I call Arab money. And that means, Qatar, the role of Qatar, the role of Saudi, the role of the UAE is becoming more significant in the financial space. I'm doing a PhD in finance now, and I would say about 20 to 25% of my class is from the Middle East. 10 years ago, you wouldn't have seen that. They are becoming an undeniably big force in global finance. And every time there is a downturn somewhere else, this region seems to benefit. So when they had very strict COVID restrictions in Singapore and Hong Kong, a lot of that money sort of went into the UAE. And the UAE was able to use sort of their downfall to sort of establish itself as a sort of formidable economic and financial center. So I think that the UAE region is one to watch. We've been seeing stories in the news of them increasingly wanting to invest in venture capital and invest in technology and invest in Africa. And I think that this is something that we'll continue to see through 2024. And also there's another power block. I mean, the BRICS, Brazil, Russia, India, China, and South Africa held their first major conference this year. And we're seeing a lot of interest from other countries, both in Africa, in Asia, and in the Middle East, wanting to join up. And, people are saying it's the end of the dollar. I really don't believe that for there's no justification for saying that. And I think the relationship between Africa and Silicon Valley will remain strong for the foreseeable future. But we do have to acknowledge within that there are other players coming into the market, and those players will also play a role, and it's something to watch out for. 1 out of every 6 people in the world right now is from Africa. That's 1.4 billion people, with some of the world's most rapid urbanization rates, some of the world's most rapid population growth rates, and the region's booming population and demographic transformation are set to reshape the continent and the world, offering this new, vast consumer market, going from 0 to 100, like what we saw in China over the past 20 to 30 years. The population of Africa is estimated to reach 2.5 billion by the year 2050. By the year 2100, Nigeria is expected to overtake China as the world's second most populous country. And I believe all things being equal, educated population, tech-savvy population, GDP is related in a way to population. Obviously, it's not directly proportional, but you do see some kind of relationship between population growth and economic growth. And this is a part of the reason why I'm so bullish on African tech. What makes it super exciting for me is something that Tim Cook said. I think it was on CNBC. They were interviewing him and asking, why isn't he manufacturing in America? Why can't he wean himself off cheap Chinese labor? And what he said to the moderator was, Chinese labor isn't actually cheap anymore. Chinese labor is only marginally cheaper than American labor. But what keeps him manufacturing in China is the fact that they know how to make iPhones. It's know-how that America has lost. But it's not that much cheaper. So with China and India approaching middle-class workforces, high-priced workforces, Africa, I believe, is a place that the world will start to look for workforce solutions. All of the big 4 countries of Africa, Nigeria, Egypt, Kenya, and South Africa, have had currency devaluations. That's 50% of African GDP, 60% of the consumer market. A huge number of the population, or a huge proportion of the population. So I think workforce solutions are a big opportunity. Outsourcing is a big opportunity with that growing population. Remember, the average age in Africa is around 20. In Europe, it's closer to 50, 60. Same with America. So it's also a young population. And that young population has a competitive and comparative advantage when it comes to building software. Some of those numbers I mentioned, but just to point out some of the other opportunities I see, 66% unbanked adults, that's a big number, a real opportunity for financial technology, rapidly growing smartphone penetration, falling internet costs. Again, really interesting, painting a picture of, a really, really prosperous Africa in the next few years. So what are the key trends or the top trends to watch out for in 2024? Growth for the strong and nimble. It may be a general VC downturn, but some of the best companies in the world were built during downturns. Uber, Dell, Airbnb, all built in these times where it was really difficult to raise capital. So I think it's going to be a prosperous year for robust companies. I think it's going to be a good year for non-dilutive financing as well, so I think venture debt will become an option for a lot of companies. And this point on capital efficiency is really interesting. I think in 2016 or 2017, I wrote an article on my Medium. You can Google it. It's called Forgot About Profit. And it was kind of like a play on words, because in 1999, Dr. Dre, who was a famous rapper at the time for Gen Zs who may not have heard of him, he released a song called Forgot About Dre. And it was actually what made that song so iconic was the first time we saw Eminem. So it was Dr. Dre featuring a white rapper, Eminem. And it was called Forgot About Dre. And it was basically talking about the fact that he thought that people had forgotten about him. And there were a lot of haters, a lot of people saying that that was his last album. And he was saying, no, I'm back now, and I'm better, and I'm stronger, and you people forgot about me, but I'm doing this song to kind of teach you a lesson. You can't forget about me. I'm going to be relevant in the industry for the next few decades to come. And yes, I took some time out because I really wanted to put a lot of work into this album, but now I'm back. And I'm back with this Eminem, unknown at the time, who's also going to be a superstar. Now, why I played on those words is because back in 2016, 2017, profit started losing relevance. People weren't talking about profit anymore. And I wrote that article saying people have forgotten about profit now, but profit is going to be back, just like Dr. Dre. And when profit comes back, it's going to be even more relevant than it was before. So all the haters have forgotten about profits. But profit is just, taking a little sabbatical for a few years while, there's zero interest rates and people are spending a lot of money, but it will be back. And this is my sort of big prediction for 2023. We forgot about profit, but profit is back. Profit and fundamentals never really go out of fashion. And with investors putting more emphasis on capital efficiency, profit or a route to profitability, at least, or a route to sustainable income, positive unit economics, are things that are going to be increasingly important in 2023. In the tech industry, we're going to make deals slower. We're going to see higher quality due diligence. We're also going to see those higher quality IPOs I spoke about in the last slide, or the last few slides. And then we're also going to see the revival of M&A transactions. So some of the larger tech companies, now that valuations are low, are going to take opportunities to buy up some of these low-priced tech companies that have done quite well. What are the industry trends to look out for? I think number one, of course, AI. But I don't think AI in the way that people are looking at AI. I think in order to do great AI investments, you need to understand the sector that it's enabling. And not just AI for AI's sake. So not just making a really, building a really bad company and throwing some AI in it, but actually my trend is AI as an enabler of an existing and underlying industry. So AI as an enabler is the first big trend that I see. Embedded finance is the second. So with digital transformation, we'll begin to see financial services embedded in non-financial products, and I think we'll see that particularly in developing countries. Healthcare. During economic downturns, healthcare actually does really well because healthcare is defensive, it's counter-cyclical, it's relatively inflation resistant. And I think, we're seeing a lot of really interesting healthcare, particularly in combination with AI and in combination with fintech. And I spoke about the energy transition early on, and I said, clean tech and renewable energy tech are, coming of age. And increasingly, we'll see climate tech companies, green tech companies, clean tech companies coming up through 2024 and beyond. So with all of these sorts of permutations about 2024, speaking about monetary policy, speaking about energy prices, speaking about inflation, speaking about geopolitical risk, speaking about other sort of macroeconomic trends and themes, what's my advice to founders? So number one, concentrate on customers. Customer is king. There's a really great YouTube video by Professor John Mullins. He teaches, I think he's still at the London Business School. I would advise you to get on YouTube and have a look. It's called The Customer Funded Business. He thinks that if you treat your customers right, then they will provide you more cash than any venture capital firm will ever can or will. So really, really focusing on customers in 2024. Build more, raise less. So capital efficiency is also one of the themes that I spoke about. And that means really focusing on building a great product and thinking and focusing on raising less money to build that great product. Maximizing success amid the capital challenges. So treating each round as if it's the last round. And being really, really focused on making your runway last as long as possible. Getting to know your sector, so digging down and really understanding the sector with specialist investors and specialist angels that really understand and can help get you customers, can help get you talent, so you don't have to spend as much money acquiring those. And then don't be afraid of profit. Like I said in my article almost 10 years ago now, I forgot about profit. Profit is going to make a comeback. So if you're going to fundraise, talk about it. Talk about your route to profit. And don't be afraid of saying that, I'm going to be profitable. And don't think that being profitable is a bad thing for investors. I think the tide has changed and people have realized that profit isn't a bad thing. And growing really fast and making a profit aren't mutually exclusive. Advice to investors. Another great Warren Buffett quote. He says, be fearful when others are greedy, and be greedy when others are fearful. And I think what he meant by that quote as it relates to venture capital is actually people were really greedy in 2020, 2021. That was when you saw people throwing money at any deal with no due diligence, sort of, just investing in any company because they had a sort of nice looking pitch deck. You saw all kinds of people, executives from banks, from industry, from consulting, leaving their companies because everybody wanted to be a founder because it was cool and everybody was greedy. And this is the time actually when Warren Buffett says that skilled investors should be fearful. But now we've moved into a time when there's high interest rates, high levels of inflation, geopolitical instability, conflicts. Nobody knows what to do. Everybody is running to fixed income and saying, government, take my money, I don't want to take any risks. And this is actually the time when Warren Buffett says that skilled investors should be greedy. When everybody else is fearful, be greedy. And that informs my opinion for LPs, people that invest in venture funds, people that invest in technology through private equity, that this is a great time to invest. I think the 2024 vintage will be one of the best vintages in venture capital because everybody's fearful right now. There's less money going in, valuations are down, serious founders and serious investors are in the market. All the tourist investors have gone back to their jobs. All the tourist investors have, set up a private credit fund or done whatever is the flavor of the month, and you're left with serious VC and serious founders. A great time to invest. Think diverse. So there's lots of research out there that I will be talking about in my subsequent presentations about diverse fund managers, about women fund managers, and about small funds under $100 million across the board. Funds under $100 million give the best return. So start thinking about small funds and start thinking about diverse funds. And then think sector. Promising sectors include, like I said, generative AI, renewable energies, healthcare, finance. So keep an eye on the top industries with growth potential. And generally speaking, specialist firms outperform generalist firms a lot. Not all the time, there's still some really great generalist firms, but specialist firms tend to have an edge. So when you're thinking about investment as well, think what really makes this strategy stand out, what makes this fund manager stand out. A tiny bit about HealthCap, the fund I run. We invest in the big four African countries, but opportunistically in other companies in Africa as well. And we do just fintech and health tech, so 2 sectors pre-Series A. And if any founders are watching and you want to pitch us, you're building in one of those 4 countries or any other country in Africa, but particularly those 4 countries in health tech and fintech, and you're pre-Series A, pitch us at pitchdecks@healthcap.co. And if you're an investor and you want to learn more about investing on the continent, investorrelations@healthcap.co. So, in summary, what have I spoken about? I've spoken about my key insights from 2024. It's not financial advice. I might be wrong, but I think I'm right. And I was right last year. So I spoke about monetary policy. I spoke about the rise of Middle Eastern influence. I spoke about the transformative role of AI, valuations, the potential risk of recession, and the impact of the upcoming US elections. And the overview really aims to offer valuable perspectives for kind of navigating the upcoming year and providing a foundation for the decisions that you'll be making. Founders, VCs, LPs, really, I'm wishing you a great year of investing and looking forward to speaking to you and working with you in the new year. Thank you.